What shows up on your tax return may not be what shows up in your bank account. The difference between income and cash flow is one of the most misunderstood pieces of financial planning. Income is the sum of everything reported on your income tax each year, from sources such as employer's pension, CPP, OAS, or something like rental. Cash flow is the amount that needs to hit your bank account in order to sustain that retirement expense month in and month out. That's where the root of this video comes from, is that one does not need to equal the other. You may have an income amount reported on your tax return, but you may receive more to your bank account the way that we've structured your investments. Retirement planning gives us some flexibility. You can prioritize which accounts you want to draw on, how much income you create, and how to keep things tax efficient through time. The goal is to strike a balance. We don't want to pull too much tax forward, but we also don't want to leave tax building up through time and eventually have a large tax bill upon our estate. Retirement planning also allows us to recognize opportunities as they present themselves. For example, someone just retiring may not have opted in to CPP and OAS, and therefore there's an opportunity to bring forward some additional withdrawals from their registered accounts. You can fill up lower tax brackets utilizing RRSP or RRIF accounts, likely at a lesser tax rate than what they would be taxed at in the future. And we can decide whether or not those dollars are needed to hit your bank account. If the money is not needed, then we can flow that out to either a tax-free savings account where it grows tax-free, or to a non-registered account where the capital is not taxed. If it is needed, well then we've utilized the tax brackets efficiently. We've gotten more money out of those registered accounts that are taxable on every dollar withdrawn. And we've increased our future base income because of our CPP and OAS deferral. We have an example that we're working through right now where the client has significant non-registered assets and significant registered assets. And they're coming up to the retirement point where we don't know if we should defer Canada Pension Plan or Old Age Security. Taking a look behind the scenes with our software, we saw that if we actually pushed the CPP and OAS out to age 70 and front-loaded a lot more of their registered accounts being withdrawn for their spending, their retirement plan was better off by $1 million through their lifetime. If you would like to see a little bit more under the hood of how we put some of these retirement plans together, let us know in the comments below, and we can do up a couple videos showing you how exactly we move these variables around within retirement plans and seeing the different outcomes that come with it. Another consideration that we have as we step through someone's retirement plan is consideration of their income level. As we approach what we consider someone's efficient income level, we are left with a choice. And that choice is whether we want to take from registered accounts that may bump our income level past what we view as being efficient, or if we want to choose the non-registered account, if available, where the capital isn't taxed and only the capital gains that are within the account that you realize during the sale, half of that gets added to your taxable income. The effect is that you get a lot more cash out to your bank account with only a marginal increase on your tax return. It's important to note that one person's efficient tax level may very well not be someone else's efficient tax level. That could be due to high income. That could be due to large registered accounts that with their minimum withdrawals that they need to force out every year can increase your base level of income. That could be large non-registered assets that through dividends, interest, capital gains, you may not see all of that money flowing to your bank account, but that is going to be on your tax return. Taxes are a part of a retirement plan. CRA will get their fair share. The goal is not about eliminating tax, it's about finding an efficient level of tax for you to pay through time. If you've found the conversation around income and cash flow interesting, hit the subscribe button. Click the bell icon so you never miss another Pellegrini Financial video. Thanks for stopping by.